So I used to own 36 stocks in my dividend stock portfolio, and I am so excited to announce that I now own 37. I just purchased a net new position in my portfolio. I don't do this very frequently because I already had 36 positions, now 37. It's a lot to manage, but that being said, the value out there in the market is so spectacular right now that I just could not pass up this opportunity. And if you invest in dividend stocks, you've been following the market, you've probably seen that there's a lot of volatility lately, and this is starting to create some buying opportunities. Those stocks that I love are starting to go on sale, meaning that the share prices have gone down. The starting yields, the dividend yields have gone higher, which is great for a dividend investor like myself because I am mainly investing for dividend income. And I love it when I can get in on sale. I can get in when the share price has gone down. I can lock in a higher starting yield. That is a great thing because I plan to live off of my dividends and I don't really care about capital appreciation. I care about my stream of dividends. So the stock that I purchased just recently this week is General Mills. I am so excited today to analyze in depth what I think about General Mills, what's going on with this stock, why I like it, why I bought it, and all of the fundamental analysis that goes behind my personal purchase decision to add General Mills to my dividend stock portfolio. Hey everyone, welcome to today's video. I am so excited to be here discussing General Mills today, my new position in General Mills, my fundamental analysis behind it, and this is somewhat of a response to the questions from the community. I get a lot of questions here on my channel. I try to add as much of my value as possible in the responses. I know all of you asking questions and also responding in the comments are adding as much value as possible as well. It's become an amazing community where everyone is adding value, and a lot of the value that I receive through here sometimes are just new ideas, new ways of looking at things. And one of the stocks that's kept bubbling up in the comments over the last month or so has been General Mills. And so I took a really hard look at General Mills. I've been spending a lot of time analyzing General Mills. I'm going to go through all the analysis today. But long story short, I ended up taking a position. I fell in love with this stock. I am so excited about it. I fell in love with it even more after the most recent drop of 8% in a single day, based on, in my opinion, somewhat of a non-event. We will get into that in a little bit, why analysts can create buying opportunities for all of us. But I'm just so excited about this particular video. It's going to be a really fun one, especially because this is a stock I can get excited about. This is the kind of stock that really gets me passionate about investing. This is why I invest. These are the types of companies I like to own. These are those consumer non-cyclicals, household brands that I love so much. These are the types of stocks that are really in my wheelhouse, and so it was natural for me to add General Mills to the portfolio, and let's just jump right into it. So first and foremost, and not even listed on here, I want to talk about the starting yield. Right now, the starting yield for General Mills, the share price is about $45 and the dividend per year is about $1.96. The $1.96 divided by 45 brings the starting yield out at a 4.36%. 4.36% starting dividend yield right now on General Mills on a world-class blue chip company, consumer brand, consumer non-cyclical, household brands that are in most houses around the United States and also around the world as well, or many houses around the world, most houses in the United States. 4.36%, that is a bargain basement starting yield in my opinion. That is the kind of starting yield that I would have expected during the Great Recession. Maybe a little higher during the Great Recession, maybe up to 5%, but we're getting there. This is a great starting yield, and so I absolutely could not resist. And so let's jump into what is happening here with General Mills. Why is it down? It has gone down from $53 to $45 in the matter of a month, a 15% drop in a single month. And before that, it's been trending down over the last few years. It's basically at a 5-year low point. Stock isn't doing very well right now, or I shouldn't say the company certainly. I think the fundamentals are solid, but the stock separate from the company, the stock is not doing very well. And so why is that? I think there are really three things happening. Two things are really affecting the recent price history. One is the Blue Buffalo acquisition. They announced they're going to pay around $8 billion or so for Blue Buffalo. This is a company that makes pet food, very high quality, organic style pet foods. And this is a big acquisition, and what I've seen in my investing history, whenever an acquisition happens, usually the company getting acquired goes up in price, company making the acquisition goes down in price. And so everyone out there in the media, they need something to talk about. There needs to be a story. And so everyone's getting frantic. Oh no, they're buying Blue Buffalo and the price is down. Well, it's something to talk about for sure, but the fact of the matter is typically when a company buys any other company, the company making the acquisition will go down. And so there's nothing unique here about General Mills. This is just characteristic of any kind of acquisition. And so it just does not scare me. And in fact, I like that they're adding that diversification to their product mix. I like having that pet food in their portfolio. I certainly think it could fuel their long-term revenue growth, which has been a challenge, will be a challenge for them, is probably the biggest challenge for them. And so I like that. But anyways, I think the street is getting so hyped up around this, whereas it's nothing new to me. Whenever I see these kind of acquisitions, I see this kind of price movement. So the other thing that I see happening is just EPS guidance, earnings per share. Just a day or two ago, a few days ago, General Mills released their earnings, and their earnings basically were good. Revenue top line was up like 2%, and that's very good because this company has been struggling with revenue. Their EPS was pretty solid as well. It was up. It was beating analyst expectations. But what scared the street is that they gave guidance. They said, hey, going forward, our earnings per share are not going to be where we forecasted. Our earnings per share, basically, instead of being $3.17 for fiscal 2018, they're going to come in closer to $3.08, which is basically very similar to what they had in fiscal 2017. So they're saying, hey, sorry guys, our earnings per share, they're going to be flat year over year. They're not going to grow. But what's interesting is if you just look at what they were going to hit, 317, versus what they are going to hit, 308, the difference is only 2.8%. The delta between those numbers, 2.8%. It's not that big of a difference, and $3.08 still a very solid EPS. Yeah, they're basically losing a year here. Why is the EPS not going up? Their costs are going up. Their costs of raw materials to produce their food are going up. And also their costs of shipping. There's a lot more shipping costs now, freight costs, they're going up. And so the analysts just went crazy with this. I'm going to link in the description below. I have a whole video about stock market analysts. I encourage you to check that out. I love analysts, and I love analysts because they create a frenzy, they create a buying opportunity. A lot of these analysts, they're not even investors. They're not like you and me. They don't invest their own money because they can't. They work at these companies, they're under certain agreements with these companies that they work with, that they analyze stocks, but they can't take positions in stocks that they cover typically. And so, and it creates, you know, it's supposed to take away their bias, and that's probably the right thing to do. But all I'm saying is, I often feel that these analysts get it wrong. I oftentimes feel that they're short-term focused. I oftentimes think that they over-exaggerate, that they hype things up, and maybe it makes sense because they're all just short-term focused and they work for companies that are trying to manage mutual funds that need to trade in and out on a daily or weekly basis. For someone like myself who is buying General Mills here with a 30-plus year time horizon and is fine if the earnings are flat for the next 5 years, and then they fix it after that, I'm looking at the long term, and so I have a completely different picture from the analysts. But anyways, these analysts, they start downgrading the stock. They start saying, hey, it's not worth what it's worth now, let's downgrade it. And lo and behold, this stock drops 8% in a single day because of this non-event, in my opinion. EPS for 2018 is going to be 2% different than what it was supposed to be. 2%. That doesn't warrant an 8% drop in the stock price, does it? Well, I'm really glad about that 8% drop because it allows investors like myself to lock in a better deal, a better value. And so I love what I'm seeing with the price history with General Mills right now. And I love my 4.36% starting yield. I can't get enough of that with a brand name like this. It is so exciting. And so I'm going to now transition in just to some of the analysis I did. So what did I do? I started with the fiscal 2017 annual report. I look at a lot of annual reports. I like them better than quarterly reports because I paint with very broad brush strokes. I don't, like I said, if their EPS is stuck at 308 for the next 4 or 5 years, I don't care. I'm looking at the long term. Where are they going to be in 30 years? Where are they going to be in 50 years? maybe one day when this stock is passed to the next generation, to my kids, what is it going to be worth in 70 or 80 years? That is how I am looking at things. I'm not looking at things, where are they going to be tomorrow? Where are they going to be later today? Does not bother me in the least. And so anyways, I look at their annual report. By the way, they did a fabulous job on their annual report. They make it easy for investors to understand what's going on. A lot of companies, they might just show year-over-year comparison or last 3 years. These guys did last 5 years. It'd be even nicer to do like last 10 years, but they made it easy, real easy. So I encourage you, whether you own General Mills, whether you don't, even if you don't like the thing, just look at the annual report from an educational standpoint. It's a good one. Anyways, their sales have been down. And so after the Great Recession, which isn't portrayed here because that was in the years prior to 2013, sales had an uptick, they recovered, they were doing well. However, since 2013, they've been in a downtrend in sales. Not so much of a dissimilar story from Procter & Gamble and Kimberly-Clark. I would say it's more pronounced with General Mills. There's more of a challenge with General Mills. It's important to go into any new position or existing position eyes wide open. My eyes are wide open here. I realize there's some challenges here. Can they get past these challenges? Absolutely, in my opinion. Are the challenges worse than what I'm seeing with some of the revenue stalling at Procter & Gamble and Kimberly-Clark? Yes, but I think this is actually a challenge worth mentioning for consumer non-cyclical in general, whether it's a food company like this one, whether it's a Procter & Gamble basic needs type company like that. These types of companies are facing some challenges growing revenue. It's going to continue to be a challenge. And it's probably going to affect the rate of dividend growth. Dividend growth is probably going to be a bit slower for the next 5 or 10 years until they figure this stuff out. But if one can lock in a good starting yield, the dividend growth, it can be a little bit slower in the first few years. But anyways, sales, no doubt about it, it's a little lackluster. Although in their recent quarterly report, sales are finally upticking about 2% year over year. So that was nice to see. The earnings are getting squeezed on cost, but at least they're pushing the sales, which ultimately you need higher sales, higher revenue to sustain long-term dividend growth. Profit is down, not as bad as sales because they've been cutting costs. So it's gone from about $3.22 billion in 2013 to 2.95 in 2017. Fiscal, by the way, fiscal years here, not calendar years. But earnings per share, it's up. They've been able, despite all of these challenges, to raise the earnings per share from 272 to 308. And this is an adjusted EPS. They adjust it for currency fluctuations because they do a good amount of business overseas. 65% in North America, 35% elsewhere. And so because of that, they have to adjust the EPS for currency fluctuation. So the raw EPS not adjusted, it's not this amount, but basically it's up. The bad news here is that they are really challenged on revenue. I think that's why they made the Blue Buffalo acquisition. I think they are going to hopefully recharge the business's growth with that acquisition. Hopefully it's a plug and play. They can plug it into their existing distribution network that they have built over the years, or I should say decades, if not centuries of operating history. But I think that the acquisition will probably help grow revenues. And again, the profit has been challenged as well. They've been good about optimizing operating margin. They've been good about cutting costs, but because the revenue growth the revenue has been declining at such a high clip, or I shouldn't say so high, 17.7 to 15.62, a reasonable clip, it's not enough to make up. But the reason the EPS, the earnings per share, is up is they've actually been reducing share count. This is a company that has been actively buying back their shares. They've been doing this in the open market. They've been doing this with probably by taking on some debt. They've been probably doing some of it through cash flow, some of it through debt, because I am seeing their debt tick up. That's another concern. The debt is reasonably solid, reasonably big for this company, although I still think it's manageable. But needless to say, the earnings per share is up. So the bad story here, it's kind of pros and cons just in this one table. The con is, number one, revenue growth. They got to figure that out. The pro is that they've been getting better at the operating margin. They've been streamlining, cutting costs. They've been able to somewhat stabilize profit. And a pro and a con is the EPS is up, which is a pro. The con is they've done it through share buyback and interest rates are at all-time lows. They're going to be going up. They're going to have to refinance debt. Could that put pressure on margins in the future? Potentially. And so I typically don't like to see EPS go up through financial engineering, through share buybacks. That said, it doesn't appear to be too aggressive here. It doesn't appear that they're taking on so much debt, at least year over year to do this. That said, it's not my favorite thing to see, but there are some pros and cons in here. So one thing I do want to point out is the PE, the price earnings ratio. When one goes to Yahoo Finance right now, it's 16.45. That's because the earnings per share on Yahoo Finance, it's not 308, it's something different because it reflects, it doesn't take into account reflection of those currency normalization. So it's 16.45. But the real PE, in my opinion, both backwards looking and forwards, based on this 308 number, is a 14.6. In my opinion. To buy General Mills or any brand of its equivalents in this market, even if it's not growing at all, for a 14.6 and a starting yield of 4.36% is fabulous. And so that's what really gets me excited here is the value. They are going through some challenges. They are going to overcome the challenges, in my opinion. It's going to be harder for them to overcome the challenges than Procter & Gamble and Kimberly-Clark, but they'll get there, in my opinion. And the PE ratio and the current valuation, in my opinion, it's overdone a bit. It's a buying opportunity. So anyways, let's look at operating margin. Operating margin was also in their fiscal 2017 report. They break it down for the 5 years. It's steadily been increasing. It's gone from 16.3 to 18.1. They are getting really efficient with their margins. 18.1 is a solid operating margin for this type of company. I like that operating margin. That makes me really happy. So dividend history. Obviously, I invest for dividends and cash flows. So the next thing I did after looking at their annual report is I started looking at dividend history. And I have found that they have a history actually of paying dividends for 118 years. It wasn't always General Mills. It was a company before General Mills that became General Mills, but basically 118 years history. They're not a dividend aristocrat, by the way, because they haven't been increasing it consistently for the last 25 years, but they've been paying. And in the last 5 years, certainly they've been increasing. Although what I would point out is the rate of dividend growth, it's been slowing. So it went in 2013 to 14, it went from 38 cents a quarter to 41 cents a quarter. Huge increase. 14 to 15, 41 cents a quarter to 44 cents a quarter. Huge increase. Fast forward from 2017 to 18, it only went up 1 penny per quarter. During these times, again, being eyes wide open as a shareholder of General Mills, I certainly don't think they will cut the dividend. Will there be years where it goes up by only 1 penny? Will there be years where maybe it doesn't go up at all? Yes, I think that will be the case. Am I willing to live with that for the next 5 years or even 10 years? Yes, because the starting yield is that 4.36. The starting yield is more than compensating for a slower dividend growth. Looking 10 plus years out, will they resume some of these types of increases? I think so. I think they will get there. I think it will take time, but I am willing to wait because I am in no rush. And so that's one of the ways I look at things. And worth noting, people might get concerned, are they going to cut the dividend? Well, their payout ratio right now, based on the 308, which I think is reasonable to look at that 308 EPS because that is normalized for currency in the trailing 12 months. It is what it's going to be in the fiscal 2018. It's a 64%, meaning they're only paying out 64% of earnings as dividends, leaves a healthy amount of buffer there for growing the business. So I want to talk about that Blue Buffalo acquisition a little bit more. I don't have the exact figure here, but my understanding is they're going to pay around $8 billion to acquire Blue Buffalo. Now, the overall market cap of General Mills right now is $25 billion. So buying an $8 billion company, if you're a $25 billion company, that is a big deal. That is a very big deal. It's a lot to digest. Let's look at it from a debt perspective. General Mills already has $9.62 billion in debt, which in my opinion is a pretty good amount. It's a pretty good amount for a company this size for a $25 billion company. Now, of this $8 billion Blue Buffalo acquisition, they're probably going to pay for $1 billion by issuing stock, but the rest, it sounds like they're going to do cash and debt, mostly debt. So this is going to increase their debt quite a bit. And so, in my opinion, they'll work through the debt. They will digest this acquisition. It will take time. It will probably take 5 or more years. I am ready for that sideways action. I am ready for it to go sideways, if not down more. And I incorporated that into my buying strategy. In fact, I did a one-time purchase, a lump sum, and then I'm going to average in over time to build my position to bring it to 1% or more of my total portfolio. And so that's how I like to look at net new positions, especially when they're in a downward trend. And I welcome that action, actually sideways action or downwards action, because long term, I see huge promise for this company, and I believe that they're making a good move with that acquisition just from my perspective. So something else I want to point out, ultimately, one can look at all of these figures. One can look at the numbers, but there has to be something bigger. There has to be something greater behind the numbers, especially when you're a dividend growth investor. You're holding forever. There has to be some kind of attachment to the company. When I was a baby and I was just growing up, I ate Cheerios all the time. Now, my son eats Cheerios all the time. I still eat Cheerios once in a while. I like Yoplait yogurt. We have Annie's crackers in our house. We love the brands that General Mills produces. They're a part of our lifestyle. They're a part of our family. And they have been for generations, and they will continue to be for generations. This is the kind of company that I can personally get excited about. This is the kind of company that gets me excited because it's something that I can stand behind. It's something I believe in. It's something I care about. There's a greater purpose behind this company. And some of their other brands, just so you're aware, there are quite a bit of them. Haagen-Dazs, Nature Valley granola bars. They have so many wonderful brands that I have come to love over the years. And that is the kind of company that I can rest assured, even when times get bad, that I am investing in something I believe in something that I want to stand behind. So we talked about the debt. I want to go back, though, to this analysts a bit. This is really fun. Just go onto Yahoo Finance and start reading some of the headlines. One of the headlines says, General Mills price target cut at least 3 times as analysts express surprise, concern after earnings. Oh no, the analysts, they're surprised, they're concerned. I could care less what they're thinking about their earnings, quite frankly. Maybe I shouldn't put it that way. Look, I want to take all data sources and look at everything, but the fact that they're expressing concern, well, thank you for expressing that concern. In my opinion, it's creating a wonderful buying opportunity for someone who has the vision to hold forever. And so I'm excited about this one for sure. So at the end of the day, just to summarize, more or less, this is a similar story to Procter & Gamble and Kimberly-Clark. Hard times on top-line growth, been optimizing their margins, cutting costs, expanding margins, operating margins to deal with those challenges, getting to a point where the revenue's got to grow. It's certainly more amplified than Procter & Gamble and Kimberly-Clark. Will they get there? I think so. World-class brand, trading at a discount, trading at a good starting yield. Dividend growth isn't going to be that great in the short run. In the long run, I think it'll be better. And no one likes it right now, and stock's trading at a low point. That's kind of my summary of what's going on with General Mills right now, and it's right in my wheelhouse. And so the one thing, though, I did before buying this is I just started looking at my portfolio. How much roughly of my portfolio is in these consumer non-cyclicals versus other stuff, other industries? Because I don't want to only be consumer non-cyclical, because maybe I'm just wrong. Maybe consumer non-cyclicals, they have a really hard time coming back, and maybe they don't come back. I highly doubt that. Having only 35% of their business outside of North America, I think that's what's going to fuel their growth, that and their new acquisition. But I certainly think there's opportunities for this company to grow. But needless to say, I don't want a portfolio that's 100% consumer non-cyclical. So I started looking, and I have a big weighting in consumer non-cyclical, but it is still less than half. When I did a quick back-of-envelope analysis, half of my dollar amount invested is in consumer non-cyclicals. So I was happy. I was okay going forward with this, this type of strategy. And so before I leave today, just a few things. In terms of full disclosure, I own stock in General Mills, Procter & Gamble, and Kimberly-Clark, ticker symbols GIS, PG, and KMB. I am long on all 3 stocks. Also, I am not a licensed investment advisor. This is not investment advice. This is just for your fun and entertainment. If you are going to go out and invest money in the stock market or anywhere else, please do consult a licensed financial advisor first. I thank you for tuning in today. I thank everyone who has been bringing this stock up in the comments. It's an exciting one. I think this is one that I would say maybe is the first stock as a community that I believe the PPCE community is kind of rallying around. comment below what you think, or whether you like it, whether you don't. Everything is welcomed in the comments below, but it seems to be a stock, at least, that's getting some interest in the comments here, and I like that. It's interesting to see what's emerging out of just the community's discussion, the types of things that are coming up. That being said, I will link to it in the description below. In my greatest mistakes video, it is a characterization of the top 5 mistakes I've made as an investor. One of them is basically placing too much emphasis on what others say, placing too much emphasis on what I was reading on the blogs. And so what I'm happy about with this one is it's a good medium. It got some press in the community here in the comments. I wasn't biased one way or another. I looked at it in depth on my own. And quite frankly, it just falls into my wheelhouse. This is the kind of stock that I really can rally behind. And so it's one of those things where, yes, there was feedback from elsewhere and interest from elsewhere in the dividend community, but it wasn't so much where I was like, oh, I'm just going to go for it because others are talking about it. It's more that, okay, people are talking about it. I'm going to take a really, really extensive look at this and see what I think. And so there's a fine line. It's a little bit subjective, but that's something also I just want to point out to everyone out there, is one of my greatest mistakes is following others. And so just because I like this stock also, and I'm doing a positive video about it, doesn't mean I'm right. And maybe with some of the other stocks I've recently reviewed where I've said I haven't liked them, maybe I'm wrong, maybe they are good. And so really what it comes down to is everyone needs their own conviction, needs to do their own analysis, needs to find their own path, and multiple paths can be correct. But given all of that, I'm excited that this is kind of the first one that is I would say a reflection somewhat of what's been happening in the overall community here. So that's great. If you have a question, a comment, feedback, please leave it all in the comments below. Please feel free to connect with me on Instagram as well. I'm going to link to that below. And I just want to thank everyone. If you enjoyed the video today, if you want to support the channel, please give it a like, comment, subscription. All of that means the world to me. If you made it this far, congratulations. This has been a longer video. I hope it was worth the time that you invested, and I will see you in the next PPC Ian video.